How should you sell your property that is owned by a company? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. So you've decided to sell your property. Now, if you've just got the one property in a company, you now have the choice of whether you sell the company or you sell the property. And there are different tax implications on whether one may be better or the other may be better, as well as suggestions of whether it's going to work for you or for the purchaser. Let's talk through how the different options fit together, and then hopefully it gives you an idea of how you may be able to structure different deals, how you may be able to fit things together to make it work for you and also the person you're selling to. So the two options come down to you sell the property in the normal approach and then the company is left behind, or you sell the company itself. Now, if we start with selling the property in the company, if there's only one property in the company, then we've got a few follow-on actions that we need to do after we've sold the property. So the property sale itself would go through in the normal approach, that you do the legals, you'll sell the property, and in essence, everything fits together. The only thing is, what will then happen is you will sell the property in the company and the company will make a capital gain, hopefully, on that property when you sold it for more than you bought it for. This means the company will now have a profit and the company will pay appropriate taxes at the 19%, the marginal rate, or the 25%, depending how much of a profit you are making. You may also have some losses that you've brought forward depending how the property has got on over the years, so there may also be some losses you can set off against that property, but potentially there will be some tax to pay somewhere in the mix on the sale of that property in the company. Now that you've sold the property, theoretically the company is an empty shell with just a bank account with some money in and the company sitting there. This can then be closed down in the normal approach, and check out the video on closing down the company. The key thing here is you may need to just consider whether you're taking things out as a dividend out of the company, whether you're taking things out as a capital distribution, which check out the video on the closing of the company, and that will talk through actually physically closing the company. Obviously, the key things that I want to mention on today's video is when you do close that company, you as an individual are potentially going to be paying dividend tax if you're taking that money out as a dividend at potentially 8.75% or the 33.75%, depending whether you are a basic rate taxpayer or a higher rate taxpayer. The alternative option is you take that out as capital gains, and in essence, as the company is sold, you get the money as a capital distribution for the shares that you own in the company. This would then mean that this is potentially a capital gains transaction. Now, we obviously know from both an income tax and a capital gains tax point of view, you have personal allowances. Depending how that has been used, for example, your income tax, we have 12,500 as the income tax. If you've already used that, you'll get taxed at the dividend tax rates. If that's not been used, then you'll get taxed after you use up your allowances. For the capital gains tax allowances, this is reduced down to 3,000. So this is going to probably be about as much as you get from allowances from the capital gains tax point of view. And then you'll be paying capital gains tax on any of the rest of the distribution that you've received. So if you receive 20,000 out of the company for your shares, you're going to get the first 3,000 at no tax because it's in the allowance, and then 17,000, which is then going to be taxed at the capital gains tax rates of either 10 or 20%, depending on what your tax position is, whether you're a basic rate taxpayer or a high rate taxpayer. So there's a couple of things there, that you're paying tax in the company when you sell the property, you're paying tax when you take the money out of the company. So depending on how much that is going to cost, you may think, is there a better way to do this? Now, if you've got more than one property in the company, then that might be more challenging because you might not want to be selling all of the properties in the company at the same time. If, however, you have only got one property in the company, or you're thinking about selling all of the properties, I should say as well, in the company because you're at that stage of your property adventure of disposing of your portfolio, it may be you consider selling the company. So when you're selling the company, you are selling the shares in the company, you're not selling the property. So that's a slightly different sales process. In this one, you possibly will need solicitors who are more commercial solicitors rather than property solicitors to be looking at that perspective to make sure that appropriate agreements are in place with everything that's in the company. Now, if you're selling the company, there are some things that you need to potentially consider. And these sorts of things are going to be things like, what are the loans in the company? Because if you've got a mortgage, when you sell the company, the person who's buying the company is going to be taking on that mortgage. Now, if you've got personal guarantees in place, you want to be getting rid of those personal guarantees when you're selling the company, because you're not going to want them coming after you if the new person is not paying the mortgage. So there is consideration to be making of what is in the company to make sure that those things are tied up when you sell the company. Other areas that we might need to consider, things like director's loan account, because I know I've worked with a few clients where they've actually put all the money in to buy the property. So there isn't a mortgage, but there is, say, 150, 200,000 personal loan into the company in the director's loan account. So if you're selling the company, are you suddenly becoming the mortgager for that new person in the company, or do you want all of your money out of the company? So they will be buying the company, but in buying the company, they will need to clear your director's loan and pay you off for that side of things. So that's some considerations to make. You may have money in the bank. Do you need to be taking that money out as part of the purchase? Are they paying in essence for that money to give them what is in the company? They'll obviously be buying the property in the company because that's the whole point of buying the company. But what are the positives of this side of things? Well, one of the positives of buying a company over buying a property is the stamp duty side of things. Because with stamp duty, we've got whatever rates it is, 3%, 5%, 8%, if you buy a property. So in our first scenario of selling the property, the person buying would have to pay the normal stamp duty. If I'm buying a company, I only pay 0.5% for shares. So potentially that could be quite a noticeable reduction in stamp duty by buying the company rather than buying the property. The other side of things that we may need to consider with the company being purchased for the person selling the company is also the fact that I'm not selling the property in the company, getting a capital gain, paying tax, and then I've got to pay tax when I take it out of the company. I'm just getting that money for selling the shares. I'm not having to pay tax in the company and then pay tax to get it out of the company. As well as the simplicity that I've now not got to close down a company and the effort and hassle and all of the things from that point of view. So there is a few benefits to selling the company rather than selling the property. Now, a lot of these things always, as it is, it comes down to the numbers. What are you trying to sell the property for? Depending what you're trying to sell the property for, how does that fit together? How messy is the company can also be a question mark. So if the company is in a bit of a mess, if you've had any issues, then potentially selling the company is not really the best of options. But if you've got a very straight company where maybe it's the property is owned, it's money owed to you, there's a bank account, the rent comes in, no issues, then maybe actually it could be quite a simple process. If you decide it's time to sell the property, you just sell the company. If it's very messy, if you've, been VAT registered in the past, if you've had issues with paying corporation tax late, things like that, then actually maybe selling the company is not an attractive offer for someone who's coming in to buy it, because they're buying your mistakes, they're buying the things that have gone wrong in the company, as well as just buying the company. So there is a few, it depends on the situation of whether it's going to be the right or the wrong option, but it's definitely something that you may wish to consider, because there is definitely some pros as well as some cons to doing this. Now, unfortunately, we can't get any business asset disposal relief for property investments, so that isn't going to be available. So for you, when you sell the company, you're going to be on the capital gains tax route, which is a 3,000 allowance, as we said before, and either the 10 or 20% tax. But the company is not going to be having to pay anything, so it is just going to be the capital gains side of things that we need to deal with, which obviously means you're not having to pay the corporation tax and then pay the income tax on the different bits that you are paying. You're going to be paying just capital gains tax on the sale of your shares in that company. What is the right option? Well, that will depend on the situation and the scenario. And if you're thinking, actually, it'd be really useful or interesting to see some scenarios, please do leave a comment and let me know, and we can put some scenarios together to show how it actually fits together on when you sell things, so that you can see actually with the numbers what is the impact and how it's going to make a difference to hopefully your decision on what is going to be the right option for you and your company, property company. Hopefully today you've discovered the options available to you when you are looking at selling a property that is owned by a company. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.